This event, as you all know, is a collaboration between UCT, UWC, and Stellenbosch University. So we've had an amazing day yesterday with our amazing speaker, Rudi, who just gave us a nice awesome start to the festival. So today our speaker is none other than Landi. I'm sure all of you know her or familiar with her because she has collaborated with Golden Key previously. So I just want to let you all know that when the session ends, you can no longer post your question. So if you really want to win or get your hands on that awesome prize from PPS, make sure that you write your awesome question so that you're able to get a nice prize. So just to give a little information, so Landi is the founding director of a professional financial consulting and training company, GTT World. We are very honored to have her join us today. So without wasting any time, I'm just going to hand it over to Landi. I just hope you enjoy yourself as we have enjoyed planning this event for all of you. So yeah, Landi.
Good evening, everyone. Thank you, Petronella, for the introduction. I can't seem to see myself. Can everyone see me and hear me properly? Okay, great. So tonight is really not about me, so I'm not going to tell you too much about me, but we're going to kick off from where Rudi left off. I hope you were all tuned in yesterday because it was such a powerful session. I mean, I was taking notes and I was like, where was Rudi when I started out? Because I would have been on a different trajectory by now. But I'd also like to thank Golden Key for this opportunity. And I think we should all congratulate Golden Key because they've lived up to their name in giving you the keys to unlocking your financial freedom. I think that's very fitting to say, well done, Golden Key, and keep these kind of initiatives going. Because indeed, there's so many people that need to hear this kind of message. I'm going to start off where I normally start off, and that is where Rudi ended off yesterday. Most of what he was talking about was your personal financial journey, your personal financial goals, and most importantly, having a vision for your finances. I don't think there's anyone that can do anything with their finances unless they have a vision, really. And the vision is really, it will guide your willingness. You're here today, and that indicates your willingness to be financially free. But you need to make a commitment at the end of these sessions to be financially free, but also stay financially free. And not get yourselves entangled in things like debt, but to stay financially free into the foreseeable future. So your vision is very important. You've got to dream big. You've got to take a pen and paper and write it down. There are no limits. There's no one who's going to mark you right or wrong. What do you want to achieve with your finances one day? You know, what do you want to do with it? Why is it important that you are financially free? And we all have different reasons. Someone's financial freedom is having a car. Another person's financial freedom is owning a yacht. Another person's financial freedom is being able to travel the world one day. Whatever that symbolizes to you, you need to write it down, because that's going to be your inspiration. It's going to be your guardrail, and it's also going to be your yardstick on how you measure your freedom, your financial freedom. So tonight is about investments. Very exciting topic, and yet also quite widely misunderstood at times. So in my journey of of investment services, I've come across many people, and the question that everyone always asks me is, where do I put my money? Now I want to take you a step back and tell you that when you ask Rudi a question, by the way, Rudi is a financial advisor, and if I were you, to get a financial advisor to sit with you and teach you is a very rare feat. I would not let this opportunity pass by. His email has got to be like, you've got to make him really busy. You've got to touch base with him, ask him questions, ask him those hard questions about investing after this. Don't ask me. No, I'm just kidding. You're welcome to ask me. But anyways, let's start about investing. So investing, you don't ask where should you put your money. The where is actually the last part. It's the very last part, and it's the last part that I will also cover in this session. Where I like to start is, what are the building blocks for investments. And what do I mean by that? Most of where you will put your money has got building blocks, like any building, right? So if you want to put your money in a unit trust, if you want to put your money, you want to trade your money, some of you want to do that. If you want to put your money in a bank account, a savings account, or whatever the case is, they all have underlying building blocks. And those building blocks we call asset classes. Why assets? Why aren't they called anything else? They're called assets because an asset is anything that appreciates in value over time. So I'd like to consider myself as an asset to my husband. I hope he's listening, hint, hint. Anyway, but an asset is something, it's a resource that appreciates in value over time. That should already get you thinking about investing, right? That if your money is not growing, then where you've placed it, is it really an asset? Are you really investing? Or are you putting it away for transactional purposes like you would do in a bank account? Now, what are the building blocks? What are these assets that I'm talking about? There are 5 different assets that we'll talk about for now. Remember, we're still going to answer the question in the end, where do I put my money? Always keep that at the back of your mind, and I'll remind you of that question. We're starting with the building blocks. The building blocks being assets. Now, there are 5 different kinds of assets that we will look at today. The first one being one that probably most of you know is shares or equity. What are shares, right? So shares is a fancy word for saying it's an ownership in a particular company. You are basically either going directly to a company and saying, please, can I buy a portion of this company? If you are not going directly, you are then going via someone else to get a stake in that entity. And we will discuss that someone else later. But a share is a fancy word for a stake or a portion of ownership in a particular company. What are the sort of returns that you get in a share? You can get dividends, and dividends are returns, or they are, call it the fruit, call it whatever you want, but it's the reward you get for buying a stake in that company. You either get a dividend when that company does exceptionally well. The value of that company increases over time, and as shareholders or owners of that company, we also get to participate in that. So that's the first building block or asset class, being a share. I must just add here that what I'm going to talk about tends to be, we tend to get in much jargon when we unpack this topic, but please bear with me because I am taking you somewhere. And if you do not understand, please write that question down. Rudi and I will try and answer them tomorrow. The first asset class, we've got a share. The second asset class, we've got a bond. What is a bond, right? Most of you have probably come across a bond at some stage in your life, whether you have a bond right now for your property, or your parents have a bond or something. But a bond, in simple terms, is an IOU contract. Why do they include it as a building block for an investment? Because at a larger scale, when the government wants to borrow money from you and me, they issue a bond. So the government borrows money from us and guarantees us payment of the money that we borrowed them at some particular date. What are the rewards that government gives us for borrowing them money? They give you interest. So you earn interest by borrowing government money in the form of a bond. A company can also issue a bond. So when a company issues a bond, it's normally because they may not have enough cash flow for what they want to do in their company. And so they issue a bond. It's an IOU contract. The company is saying, Landi, Petronella, Sean, borrow me money And for you borrowing me that money, I'm going to pay you interest every month for a fixed period of time. So that's simply how a bond works. And it's the second building block or asset class that we have. The third building block is what we call property. Property is an asset class and it is a building block, an investment building block. What do I mean by property? You can either own property physically that you can touch, or you can buy a share in a company that develops property. So most of us have seen all these townhouses, all these flats, all these estates that are built in South Africa. Those are built by property developers. Things like malls are owned by property developers. So you can either physically build a mall yourself and own it as an asset class, or you can invest in a company whose sole focus, nothing else they do, their bread and butter every day is to develop properties do well. What sort of returns do you get? What sort of fruit do you enjoy from owning the asset class called property? The property can appreciate in value. It can increase in value. You can buy a property today for 300,000, very wishful, but let's say you could for 300,000, and over time it appreciates, it increases in value based on things that happen around it. Sometimes people have been fortunate enough to buy property next to a vacant land, only to find that in that vacant land there were minerals like platinum, and so that automatically increases the value of a property. For example, if you are building a shopping mall, the type of tenants that you have in the property will increase the value of the property over time. You can also earn another fruit or another reward for owning property is rental income. So some of you may be renting apartments right now as students. The person you're renting from is enjoying life because you are their tenant and you are giving them rental income. So they own an asset called property and they get rewarded in the form of rental income. I've covered 3 asset classes so far. I've spoken about shares, which is ownership in a company, and the returns of shares is either an increase in shares, in the value of the shares, or dividends. I've spoken about bonds, which is an IOU contract that is either given by government or a company, and the reward for that is interest every month that you get, or whatever the terms of the bond are. And the third asset class I spoke about is property. Property being a physical ownership in an asset that you can touch, a building that you can touch, or investing in a company that solely focuses on developing property. The reward for property being rental income or the increase in the value of the property. I hope I'm going slow enough for everyone, because what I'm doing here is giving you the asset class, and I'm also giving you the type of return that the asset class gives. I repeat, we are going to answer the question in the end, where do I put my money? Your mind must already be starting to think about these building blocks, because they are already starting to answer the question in one way or the other. The fourth asset class that we're going to talk about is cash. Now, I've often heard people say that cash is king. Debatable. Cash is king, yes, if you are an entrepreneur, sometimes. Cash is king, yes, when the economy is not doing so great and the other asset classes are not giving you the reward that you desired because of things happening around, like the season we're in now. But cash sometimes is not necessarily king, because the interest rate or the reward of holding cash can be very low. And the reward of holding cash is interest. Now, let's look at a practical example. So cash in your bank account, if it really is king, you would be balling right now with it, with the kind of interest that you'd be enjoying. I'm giving a hint here as well. Start thinking about it. So if cash is really king, those of you that have money in a 32-day account, you should be on the world's wealthiest list by now if you put that money in the 32-day account 5 years ago or 7 years ago, or your parents put it in there when you were born. If cash is really king. But I'll talk about that a little bit later. But the fourth asset class is cash, and that is another spin to cash is what we call foreign currency. Now, foreign currency, I know your mind is probably racing to trading. Yes, that's where foreign currency trading comes in sometimes. So when cash is not king and it's a prince at some stage, when the economy is down, some investment managers opt for trading currencies, and they trade it over time to just make quick cash so that they can boost the reward that the cash is giving them, which is not so great at that time. The fifth asset class that we have are what we call commodities. Commodities are your oil and gas, they are your gold and silver, we call them precious metals. You've got your copper and your iron, which we call industrial resources. And we've also got wheat and rice. Those are what we call commodities. You can either also have them physically. So you can have a block of gold in your house kept for someday appreciating in value. You could have platinum, you could have diamonds, you could have copper, you could be a trader in copper, you could be a trader in iron, for example, or you can invest in companies that solely focus on that particular commodity. Your De Beers that do diamonds, what else could I think about right now off the top of my head? But there's various companies. I can't think of anyone now, but there's various resource companies whose sole focus is on trading or investing in commodities. So you can either go directly, or you can invest in companies that invest or trade in commodities. I'm going to refresh a little bit. We've got shares, the returns being the growth in the shares or dividends. We've got property, the returns being the growth in the building or the property or rental income. We've got commodities, the returns of commodities being the appreciation in value of those commodities. We've got cash, the returns of that being interest, and we've got bonds, the returns of that also being interest. I hope we're still on the same page. We're going to answer the question, where do I put my money? And I do hope that you're taking notes, but it would not be correct to talk about asset classes and talk about their great returns and what we can get from them without talking about the risk aspect. The risk aspect is simply a fancy word for talking about what can go wrong when you put your money in any of these 5 asset classes, or when you put your money in something that has 1 or 2 or all of these building blocks. So let's look at the asset classes and look at their risk. I'm not going to go into detail on the types of risks that each asset bears, but what I will tell you is their risk profile. So we'll talk about the building blocks and talk about which assets hold a high risk and which asset classes hold a low risk, for example. So let's look at shares. Shares are considered to be a high risk asset class or building block. And why is that? Let's think about it. So let's look at a share like African Bank. I'm going to use African Bank deliberately. I don't know how many of you know about African Bank, but it is a stock that everyone was pretty confident about because it just suddenly blew up as a loans bank. I don't want to say everyone, maybe let me be cautious. Many portfolio managers or people that manage money were very confident about a share called African Bank. And they were confident because, geez, African Bank was borrowing money to everyday people. African Bank had favorable payment terms. So they would give you a loan if you could prove that you are employed for a certain amount of time and that you have a certain level of income, they would reward you with a loan. Now, over time, I think African Bank got very excited, like most entrepreneurs do when it looks like they're doing well, or when they are doing well. The African Bank got very excited. It started going to literally anyone and everyone and approving loans, and they were really outshining their competitors in terms of issuing loans. But you see, the thing of issuing loans, and so you can imagine what happens to the share price. Everyone, the buzzword is on about African Bank. African Bank is it's issuing loans. People are paying back. It's doing unbelievably great. The confidence in the market. When I talk about in the market, I'm not talking about Landi's fruits and veg store. I'm talking about the Johannesburg Stock Exchange. The Johannesburg Stock Exchange, traders are excited. Oh my goodness, that one wants to buy a share in African Bank. This one is selling a share in African Bank, and it quickly goes. So when there's a demand and a supply of a certain share, the share price is affected. So as the demand of African Bank goes up, the share price goes up, you know, and the market value, the sentiment on the ground is that African Bank is doing well. And so people start buying African Bank, and African Bank is reportedly said to be doing well. One fine, sunny, beautiful day. I was still working for an asset manager at that stage. African Bank, literally traders on the stock exchange watched the share of African Bank tumble to almost nothing. And the reason for that was simple. African Bank was starting to struggle. So they had given out so much money, but the settlement of those loans, people were not meeting the demand of paying back those loans. Why is that? Some of African Bank's biggest clients were miners. They would literally go into a mine, they would sell miners, not miners as in children, but people who mine gold or mine commodities, just for clarity. So they were selling to miners. Now, you remember there was that whole saga around Marikana and the strikes in the mines. People lost their jobs. They couldn't pay back the loans. And African Bank just couldn't service what it needed to service. It couldn't afford itself, basically. And so the price of African Bank, the share, started going down. And many portfolio managers that I personally know in large asset managers and investment managers were fired. They were let off because the unit trusts that they had, or the funds that they were managing, had lost so much money because they had put in so much of the client's money in buying African Bank shares. Why am I telling you the story? Yes, those things happen in the market. And yes, some of the portfolios that I personally had African Bank as part of the share, as one of the shares that were in the portfolio. Did my investment go down? Totally. I'll give you another scenario. If there are any politicians here or anyone whose parents are politicians, this is not to discredit anyone, but it's for illustrative purposes. So during the era of a particular president coming into power in South Africa, probably four to 6 years ago, I think 6 years ago, there was huge concern in the stock exchange that, sure, would this man be able to do well for the economy of South Africa? Investors were so skeptical. And so many of them wanted to take their money out of South Africa because they were just so afraid of losing money. What do I mean by losing money? They were afraid of an African bank situation. One day my portfolio was up there, and then the next day it just tumbles down. I'm going to use myself as an example. My retirement annuity at that stage had certain shares in it, and the price of that share, of those shares, were just affected by the announcement that he was going to be sworn in as interim president, not even as presiding president, but as interim president, while they were transitioning and waiting for the election. I think probably 25,000 Rand worth of my pension went down during that period. And that should tell you that shares go up and down every single day. Now, if I was someone that had no long-term view to my investing, to the investing of my pension, I would have probably withdrawn it at that stage and done something silly with it anyway, because I was not too clever in those days. So what I'm trying to illustrate to you here is shares are a high-risk asset class. And if you're looking to invest in something that has shares or to buy shares, you must sort of have a long-term view. So you can't put your money in a unit trust, for example, that has shares in it or 100% shares in it, and you want to withdraw your money in 3 months' time. It doesn't make sense. You may be withdrawing at the wrong time. So imagine in January, if you had put in your money, or in November, you put in your money in a fund or you bought shares, and COVID happens in March. There's a lockdown in South Africa in March, and all of a sudden you want to get out. It's the wrong time. Then you shouldn't have been. That asset class was then not for you for 2 reasons. Because number one, you invested in a high risk asset class and you didn't have enough time for that kind of risk. So time and risk, there's a relationship there, which I will explain as well. So if you're looking to invest in shares, it's important to realize that it is considered a high risk asset class, not high risk because you're going to wake up one morning and the value of your portfolio that Rudi is managing is 0. No, high risk because today you're going to sleep and your portfolio is worth 10,000 Rand or your funds, and tomorrow morning you're going to wake up and it's worth 8,999. Then you're going to wake up again a week from now and it's going to be 10,100. And you're going to sleep and wake up a month from now and it's going to be 10,001 Rand. Now, if you're the kind of person that would have palpitations from such, or you would need a bottle of whiskey to sustain yourself, then shares are probably not for you. Or a fund that is invested in shares, 100% is probably not for you at this particular stage. But it may be for you for a longer period of time. Now, the next asset class, for example, property. Property is I'd say a medium to high risk asset class. Why medium to high risk? Unless you're speculating in property, and speculating being you are this genius of a person called Sean, you can buy a property today in Franschhoek and sell it 3 months from now and get your profits because you've done this before, your grandfather taught you, or whatever the case is. You know, you can't really hold property for a short period of time. Why is it medium to high risk? Medium to high risk because the value of your property is not only determined by what a rent prop will tell you it's worth, or 𝑦𝙬 or CF or whatever those agents' names are. It's not necessarily dependent on that only. It's dependent on so many factors. I'll use an example to illustrate why property can be a medium to high risk as well. I hope this is making sense. And these examples, nail the message in. I had a friend when we graduated who bought a property in Parklands. And at that time, Parklands was still starting out. There was literally nothing except, I think, Table View Mall. Parklands is an area in Cape Town. For those of you who don't know, I think you should all know Parklands because we're talking to Cape Townians. But just in case there are Joburgers who are thinking, where's that? Is it next to Soweto? No, it's not. It's in Cape Town. And at the time when she bought her flat in Parklands, there was literally nothing. And, she spoke to a couple of us, do you think I should buy this property here? And I was just like, sure, it sounds like a risky investment, not because I know the asset class is medium to high risk, but there's nothing here and anything can happen. So I think she was overly optimistic that Parklands would become the next century city. And I was cautious and said, it could become the next century city, or it could become the next, I don't know, it could become the next Hillbrow. There's nothing around there. Don't you want to wait a bit and rather rent and see how it goes over time? You've got the money, let the money earn interest, and you can withdraw it and buy your property at that particular stage. Or maybe go and buy a property in an area that's a little bit settled and you know what's going to happen more or less. I mean, you don't know for sure, but you know what's going to happen more or less. So let's say she bought her property for 600,000. Over time, I'm not joking, we watched the value of her property depreciate, go down year by year. And by the time she sold her property 4 years later, she could only recover 250,000 of it. And the property, the complex itself was so dilapidated. It was, it literally looked like Landi had built it and probably sold it to university students who didn't care. I didn't care at the time when I was in varsity. Terrible, terrible. So never emulate me. And don't ask me about my story because I won't share it. But it was so bad. The neighbors, no one wanted to buy that property for more than 300,000. And at that stage, I said, I told her to get out, because if she could sell it for 250, that was great. It was a terrible, terrible decision. So I'm sharing this with you because very often, one of the questions that I saw come through is, do you think we should rent or buy? Research a little bit, research a little bit the area. Who are these people? Read. Where are the next developments happening? Who are the developers? Are they Landi who woke up yesterday in the morning? Or have they done great work in other provinces or in other areas? Are they a new player? What do they look like? If there's nothing around that area, what is going to come up in that area? Do your research. The should I rent or should I buy decision is the last part. The first part, when it comes to property, is actually it's doing your research on that area, on your neighbors. When I say neighbors, I'm not saying like, are they old and going to die tomorrow morning? No, I'm saying, are there malls? Are there shops? Are there hotels? Could tourists be coming here? Will it boost the value of the property? Are they next to a brothel? Are you interested in buying close to that? Are they next to Liquor Town? What does that mean for you and noise on weekends? Are they next to a club? Are they next to whatever, an airport? Can you rent it out on Airbnb as a stopover for businessmen and businesswomen? There's a lot to consider before the buy or rent decision. You've got to do your research. Assets like shares are not one of those things that you wake up in the morning and you say, now is the time. I feel good today. No, you read, you follow things, you ask questions, and then you can go into those kind of things. Or you can look for funds or investments that hold those type of things, because you know that the team that has chosen the company to invest in, the shares, the property company to invest in, has done their homework for you already. So property is a medium to high risk asset class. Again, property and shares, you don't normally hold for the short term unless you really know what you're doing. At this stage, people normally ask, should I be trading in shares? I want to say if you know what you're doing, but so do gamblers at casinos know what they're doing, hey? Your pick. I think I've given you the answer. I don't want to discredit share trading or anything like that, but I believe gamblers as well know what they're doing. So if you're doing that for the short term and you're saying, I'm going to buy a share today and sell it tomorrow, you may not know what you're doing. So tread carefully. But generally, shares, because they are higher risk asset class, you don't hold them today and sell them tomorrow morning or the next 2 years or so. You keep them for 3 years plus, 5 years plus at best. And property being the same thing. Because it's a medium to high risk asset class, you want to hold it for the longer term. Remember, I said time and risk are related. So generally, as a rule of thumb, a test, not even a rule of thumb, as a test for yourself, the longer the period of time you want to make your money work for you, or you want to invest your money, the more risk you can afford to take on. I'm going to rephrase that, bringing in the asset classes. The longer the amount of time you have to invest your money, the higher risk asset classes you can afford to take on. Right. Looking at things like commodities, you've also got, some say high risk, let's call it medium high risk for, the price of gold. And I'm going to challenge everyone to start watching the end of the news. You don't have to watch, or you can watch CNBC Africa, or you can watch Bloomberg News, or you can watch, there's so many news that you can watch that are not necessarily gossip and, meaningless things. But if you don't have time, just go to News 24 or Google, what's the gold price for today? And just start noticing these kind of things. What are you doing? Yesterday, Rudi spoke about empowering yourself. He spoke about getting knowledge. It's important. These sessions are never going to be enough. We are starting a series next month called Financial Fridays. Even that is not enough. We're going to be giving you homework there. You need to go and read for yourself. Because when you go and read for yourself, like you are students right now, the information settles in and you feel like you're part of the journey, as opposed to us sitting here and you sitting there and we're giving you information. So have a look at the gold price. Start seeing what they are saying. Google the iron ore price. What is it? What is copper selling for? What is rice selling for? And what is rice selling for in different countries? In Malawi, it will be cheaper than what it is in Brazil, for example. Have a look at those kind of dynamics, because you're educating yourself in that process. Some of you sitting here are going to be trading in physical commodities. So some of you here are going to be physically transporting copper from Petauke in Zambia down to Beira in Mozambique. That might be of interest to you. And I say that because nowadays, it's not important what you study, but the knowledge and the opening of your mind and using what you have studied for other things. So digress a little bit. Coming back to the risk profiles of asset classes. We spoke about shares, high risk asset class. We spoke about property, medium high risk. We spoke about commodities, high risk stroke medium risk. We're speaking about bonds now. Bonds, they normally say, are a low risk asset classes. Remember what bonds are. Bonds are an IOU contract. Why do they say they are low risk? I mean, can you imagine the government of South Africa borrows money from us or issues the RSA bond, and tomorrow morning the RSA bond goes bankrupt? I don't want to say it's impossible. That's why we say low risk and not no risk, which is very important. There's a huge difference between the two. We never say no risk. There's no such thing as no risk. Even getting married is a low risk type of transaction, not transaction, but relationship, whatever you want to call it. Having children is low risk. They can turn out to be anything, but we trust there'll be something great in life. So we say low risk, not no risk. So a bond is a low risk asset class because of the type of people, and it's predominantly government that issues bonds, but companies from time to time as well can issue bonds. And companies that often issue bonds are companies that have sort of raised the money that they need by issuing shares or by offering shares, and they need more money for bigger transactions or to do bigger work in their entity. So those are considered low risk asset classes, bonds. Cash, we say they are also low risk, not no risk. There's no such thing as no risk. Cash is low risk. Why? One of the risks, one of the biggest risks for cash is what we call inflation. Now, inflation is a fancy word that people like myself and Rudi like throwing around when we want to confuse you guys. But really, inflation is just the price at which things, being goods and services, increase every year. Simple example, the cost of bread 20 years ago is not the cost of bread today. The cost of bread 20 years ago, when I was growing up, it was probably, I think, 2 Rand 50 or 5 Rand. I can't remember. I think it was 5 Rand for a good loaf of sliced brown bread. I mean, where are you going to find sliced brown bread today for 5 Rand? I don't even know how much it is because I don't eat bread. But I think I'm a bit fatigued from those days when I only ate bread, so I'm over bread. It's got nothing to do with fancy, healthy things. I'm just over it. So the price of bread then being 5 Rand, and the price of bread, let's say right now, is 10 Rand. The difference in that, the 5 Rand, is what we call inflation. That's just it. Inflation is the price or the cost at which things increase or change by year on year. I'm talking about cash. Why is inflation a risk to your cash investment or your cash portfolio? It's a risk because you could think in your bank account this year, you have 1,000 Rand and you think that's sufficient to buy you the same groceries that you enjoy today as a student 5 years from now. That's not true. The food the noodles you eat today, sorry, I used to eat noodles as a student because I couldn't afford spaghetti. But anyway, the noodles that you eat today or whatever your basket of food is today is not going to cost the same 5 years from now. And so that's the risk of holding cash. Your money needs to be somewhere where if you put 1,000 Rand today, it will grow at the same amount that the price of goods is growing at year on year. So 1,000 Rand today, when it grows in your cash portfolio, your cash investment, has got to be able to afford you the same lifestyle 5 years from now. So inflation is a threat to your cash investment. That's the biggest risk for your cash investment or your money sitting in your bank account. I said to the guys the last time that putting money sometimes in cash portfolios like your 32-day account, I don't know what these type of things are, but there's smart this and smart saver or something like that, but it's something that you move money from your transactional account to something else, or a pocket, some of them call it. The risk with that is, before I talk about the risk, it's probably not too far off than playing hide and seek with your money. So you're literally saying to your money, I'm moving you, I'm putting you in there. Hey, I'm going to find you one day when I seek you, but now I'm going to hide you. Why would you play hide and seek with your money if when you find it one day and you seek it one day, it can't afford you what it could afford you 3 years ago? So cash is, it's not something that you say you are investing in. It's a parking bay. You know, it's just a parking bay until you are sober and understand what to do with your money or where to place it. And cash, again, is considered to be a low-risk asset class and not no risk. It's a low risk, right? The easiest way sometimes to think about cash as well is to think about it in terms of, I know people will talk about things like foreign currency trading. Is it a low risk? Is it, gambling is also considered low risk, because they say you sit in front of the machine and you pull the lever and something happens. I don't know what happens, but people that believe in gambling say it's a low risk thing. So trading in currencies and stuff, teach yourself first if you want to do that kind of thing. Learn, read books, try it out on demo accounts, speak to people like Rudi on what they advise clients to do if they want that kind of kick from knowing that they sold $1 here and they bought £1 here and they got the difference in the return. It's not something that you say, I'm investing in this thing and I'm going to just put my money in there, and you haven't researched about it, or you're not giving it to the experts who trade in cash. So I hope that's given you an idea on what I'm talking about when I talk about the building blocks, and I hope it's opened up your mind a little bit to how you answer the question of, where do I put my money? After this, no one must go to Rudi and say, Rudi, where do I put my money? Rather, the conversation should be, I have done my research. I kind of have an idea of the 5 different asset classes. I'm going to recap. We've got shares. Shares are an ownership in an entity. The return of shares is the increase in the value of the company or the share, the ownership that I own, and the dividends that I receive from that company. What type of person invests in shares? It's a person that has either a high risk appetite or they are in it for a long term, being 5 years plus. Then we've got, secondly, something like property. Property, you can either hold the physical tangible asset, or you can hold shares in companies that develop the physical tangible building, right? What type of returns do you get in property? You can either earn rental income, or the value of that property can go up. What type of person invests in a property asset class or in funds or investments that hold property in their portfolio? It's a person that has a medium risk appetite and is also in it for the medium to the long term, being 3 years and beyond. They want to keep their money in there for 3 years and beyond. Thirdly, we've got what we call your commodities. What type of returns do you get in your commodities? You get the increase in the value of the commodities over time. A commodity is things like your oil and your gas, your steel, your copper and your iron ore, your silver and your gold, right? The returns being the increase in value of those particular resources that you hold. What type of person would go into investing in either commodities directly, or if you want a portfolio that holds commodities in it, it's someone, again, that has a medium risk appetite for investing. They might sweat a little, but they're not going to have sleepless nights, right? A bond, we have a bond. A bond is an IOU contract, either issued by a government or a company when they want to borrow money from you and me, and in return, they give us interest for borrowing them that money. It's a low risk asset class. People that absolutely love bonds are pensioners. They are not trying to get a heart attack from the up and down of all these other asset classes. They just want stability in their money. So very often you'll see senior people saying, I just want a bond fund. I don't want funny things. If you must put me in something like a shares or an equity fund, equity is another word for shares. So if you must put me in an equity fund, a little bit. I don't want too much of it. So a bond, we've got as the fourth asset class. Then we've got the fifth asset class being your cash. Your cash is the instruments like your money market account, very low risk. The returns are interest. What type of person would put their money? It's a person that doesn't have too much time. They just want to gather some money until they can put it somewhere else, or until they sober up about putting it somewhere, or they are just saving for the short term or investing for the short term. Like me, I have money in money markets, and I have money in money markets because I use that money in December to make it rain for my family. So I look like this exceptionally wealthy woman. When I go to Port Elizabeth, I am like the favorite of the family. But all I've just done is just put away, I think 250 or whatever, but in total it's about 500 when I combine it with hubby. And we literally withdraw it in December, and we cash it into 20 Rand and 10 Rand notes, and we dish it out. I mean, you can imagine what I look like. Like, I'm the most loved person in my family. Everyone's looking forward to December. That's what you do with your money markets. It does earn a bit of interest, but it's nothing to write home about, really. And I don't even call it an investment. I call it my parking bay that gives me something while I put it away. Another reason you would use a short term, you would use cash things for short-term things is some of the stokvel groups or saving clubs that I belong to. One of them is a property savings club. So every year we accumulate money into a money market, and then we take that money and we try and look for a physical property to buy. There's 4 of us in it. We throw in money there the whole year for 12 months. Then we shift it. If we don't find anything lucrative in those 12 months, we then shift it into a 2-year thing that we can afford to take on a little bit more risk. Right. I hope this is making sense to everyone. So let's recap. What have we learned from this? Spoken about asset classes. We've spoken about the returns that the asset classes give. And we've spoken about the risk profile of different asset classes. Now, what can we conclude on these 3 things that I've spoken about? Number 1, generally, you want to put your money away where it will preserve. It will preserve what we call the buying power of your money, where the returns will beat inflation. Remember that thing called inflation. You want to put your money away in some vehicle where, when you look at it today and you put in 10,000 Rand today, when you withdraw your 10,000 Rand 5 years from now, you can still afford to buy the same things you could buy 5 years ago. So you always want your returns to beat inflation. You want your returns to beat inflation over time, to preserve the buying power of your money. What is the second thing that we observe? The second thing that we observe is, if you don't have, look at the amount of time that you have for allowing your money to grow. If the amount of time is short, you cannot afford to take a high risk asset class, either directly yourself, getting the physical share or the physical property, or indirectly through a fund that invests in that particular asset class. Generally, the longer the period of time you have to invest, the more the risk you can afford to take on. Right? I hope we're making sense. Now, let's bring it all together. Rudi yesterday spoke about your financial goals. He spoke about things that you can start doing to earn passive income today, right? What do you do with that passive income? He's got a financial lifestyle now where he lives off his passive income. I think when I grow up, I really want to be like Rudi because I'm not there yet. I'd love to be there, but I think my passive things, I'm such a risk taker that my passive things end up being my holiday money or I don't know what. I love food. So yeah, I think my passive income goes into food. It's terrible, I know, but I really love food and traveling. So going back to that, he spoke about you setting up systems that can literally earn you money, sometimes while you're awake and sometimes while you're asleep. From that, you should be able to develop and sit now and say, right, what are my financial goals? Are my financial goals to get out of debt? Are my financial goals to get out of debt and build 2 streams of passive income? Are my financial goals to retire at the age of 40? Are my financial goals to make sure that when I graduate, I'm able to buy a car so that I don't struggle during my years of articles? Are my financial goals to buy my current girlfriend a diamond ring so I can marry her in 5 years' time? I don't know what your financial goals are. You need to determine what your financial goals are. But your financial goals will not come unless you write your vision down. I want to give you how hectic I am about my financial goals. I mean, my vision. And my husband is the total opposite. So when I was still in varsity, I think I was in first year, I started developing a liking towards investments and finance. I'm an accounting major, but accounting is not really my thing, I must say. It's a good skill to have. It's just not for me. So one of the things that I wrote down, and some of the things that I wrote down as my financial vision included having a house that has a helipad. Why? Because I just want to pop by, have a swim in the sea. I love swimming. Have a swim, and then quickly helicopter back to my house to cook a gourmet meal and entertain my guests. That's my vision, but it doesn't necessarily have to be yours. My other vision is holding certain properties in certain cities. Why? Because I travel quite extensively for work. Where do I want an apartment? I want a penthouse in Dubai. I want a penthouse in Lesotho. I don't know what I want in South Africa. I'm a bit undecided. One day I want a game reserve. The next day I'm like, I don't like frogs and lizards and all these funny things, so I don't want that. That's my vision. That's how wide I've cast my nets, because there's no limit to what a vision is. I'm not going to limit it and say, I don't know what your limitations are, but why do I want to afford myself this lifestyle? I want to afford myself this kind of luxurious and extravagant and highly prosperous billionaire lifestyle, because at the core of who I am, I really just want to help eradicate poverty. I want to literally travel across the globe, giving solutions on how we can practically empower people to get out of poverty, especially in Africa. And I don't want anyone to pay me for doing that. I want my lifestyle to pay me for doing that. So I'm working hard now and putting systems in place now so that in 10 years from now or 20 years, I don't know when I'll have that lifestyle from now, all I'm doing is just living for a purpose much greater than myself. That's what I really want to do with my life. You know, what are your financial goals? And so my vision, sorry, that's my vision. My financial goals are driven by my vision. What do I mean by that? Some of the financial goals that I had to write down was, I need to get out of debt. I got into debt as a student. I need to get out of that nonsense. I want to get out of debt and I want to be debt free. That's a goal of mine. What was my second goal? My second goal was to hold property as an investment so that it pays me every month for the kind of things that I want to do. What was the third goal? The third goal was to buy a house for my mother. The fourth goal was to take my entire family out of poverty. And we're getting there. We're getting there. I am helping family members pay up their debt as well. I'm not saying I want to make them rich. I just want to help them be financially free. That's a goal of mine. Because you know what happens? If I've got this billionaire lifestyle and my sister next door is struggling to make ends meet with her car payments, I'm not really free because she's going to infringe on my wealth and I'm going to have to share it with her. So let me help her now get out of debt and let me help her now structure her life so that we're all enjoying the financial freedom that we want to enjoy. So my goals are determined by the huge vision that I have. My goals are the baby steps that will get me to this end vision. Very important. Rudi touched on it yesterday. Please go back, listen to his teaching, let that sink in, because really that's where everything begins. It doesn't begin with where do I put my money. It begins with the why. And I can't overemphasize that, because when you don't have your why, things will come at you in life. Maybe business failure, maybe, I don't know what, retrenchments and all sorts of things. But your vision and your financial goals will keep you on track. They'll motivate you. They'll make you not get distracted by the noise around you as well. So you've got your financial goal. You ask yourself, what is your financial goal? Number two, you ask yourself, how long do I want to put my money away for? What is my financial goal? Number one. Number two, how long do I want to put my money away for? Do I want to put my money away for 12 months, for 2 years, for 3 years, for 5 years, for 20 years, for retirement? How long? Determine that. Number three is, how much do I want to put away? And be realistic here. I think it's quite, I mean, I used to chuckle, but I don't anymore. I think it's quite silly that people will say, I want to put away 1,000 Rand every month as a student, but they've got a stipend of 1,200 Rand. Can you honestly say for yourself, some people could live off 200 Rand and I could back in the day, because I had all my meals covered, all my accommodation. I had people just bring me toiletries every month or whatever the case is. So maybe I could survive on 200, but be realistic. I'm talking about your situation. If you want to put away 1,000 Rand every month and your stipend is 1,200, does that make sense? Because what's going to end up happening is you're going to be excited about putting away 1,000 Rand, but you're going to go and borrow 300 Rand from your friend because you can't access the money or whatever the case is. You know, so be realistic about that. How much can you realistically afford to put away? And then also the frequency of what you're putting away. Frequency being, how often? Are you putting it away once a year? Are you wanting to put it away every month? Are you wanting to put it away quarterly? What does that look like for you? Only you can determine that. And then number 5 is, what is your risk appetite? Are you a risk taker like Landi? Are you risk averse? Risk averse being, hey, you understand these things called risk, but you're like, I don't know. Hey, I don't know. I still want to, you know, swim in the shallow end a little bit. What's your risk appetite? So if you imagine a swimming pool, the easiest way I can always explain your risk appetite is, if you imagine a swimming pool, there's the shallow end. You can't really dive in the shallow end. You know, it's nice in the shallow end. You can go in and you splash your face, yes, you're swimmer, and all these things, right? So it's okay there, You have a little bit of fun and you can run across and all sorts of things, right? But the real fun is, and I say real fun, is in the deep end. You can do somersaults going in there. You can dive down and see how low you can go. There's all sorts of things you can do in the deep end. The deep end being shares. But you can't go to the deep end unless you know how to swim in the deep end and you can stomach the risk of being in the deep end, right? The deep end being your shares, your property, your commodity moving towards the middle part of the swimming pool. The shallow end being your bonds and your cash. So if you look at it like that, as that spectrum, think about your risk appetite. Where do you stand? Not your swimming appetite now. I know I'm using a swimming pool, but your risk appetite, right? Where do you stand? We're going to only answer the question, where do you put away your money now? See how long it took us to get here. It's not a quick, where do I put my money? And we thumb suck and say, I think you look like Landi, you look like you should put your money away at Alan Gray, or I think you look like, I don't know, whoever, you should put your money away at Investec. It's not like that. You answer the questions for yourself first. So you determine, it's like having a toothache. The doctor doesn't determine that you've got a toothache. You know it. You know yourself that today it's not happening. Like, I am in so much pain. By the time you go to the doctor, you have diagnosed yourself. I've got a toothache. It's on the right side of my teeth. This is how it feels like. But you don't go now to the doctor and say, doctor, I think you should give me Panado. You have an idea of what you want. This is important because a lot of people go to financial advisors and expect them to do the work and then come back and say, my financial advisor didn't give me the right advice. But you also didn't do your homework. You didn't determine your financial goal, number one. You didn't determine how long you want to put your money away for, number two. You didn't determine how much you could put away, number three. You didn't determine how often you want to put it away, number four. And you didn't determine, number five, what your risk appetite is. So what some of you literally do is to just jump in and you're like, here I am, doctor, do your thing. I just heard that you're a doctor and yeah, I don't really know why I'm here, but I do know that, once a year, I must kind of come and visit you. That's not how you approach your financial health, because that's also not how you approach your physical health. Your financial health is important. You need to sit, you need to unpack it first, and only then can you go to someone and say to them, if you're confident enough and you're comfortable enough and you want to learn, of course, you can go out there and start reading about what type of investments suit these 5 answers that you have given yourself, right? But if you're not, then you speak to an independent financial advisor and say, look, I've answered these questions. I need your help in terms of what I need to do. There are many other questions that the financial advisor will ask you, but this is the basics. And when you're sitting in front of them, the things that they are saying are not new to you. All of a sudden you remember, gee, I learned about inflation. I learned about risk. I learned about asset classes. I learned about that. There's some form of knowledge in you when you're making these kind of decisions. So let's use an example finally to answer the question, where do you put your money away? Let's use an example. Let's say that your financial goal, number 1, is to buy a car. How long do you have to buy your car? You tell yourself you've got 4 years. How much realistically can I put away to buy my car in 4 years' time? I can put away 250 Rand every month starting from today. How often do I want to put it away? I want to put it away monthly. right? And what is my risk appetite? Yeah, I could afford to take on a bit of risk because I've got 4 years, but I just don't want too much risk at this particular stage. By answering these questions, you have now profiled yourself. Why do I say that? Number one, because you've got 4 years. Hello?
Did we lose Landy?
Hello?
I think she's back on now.
Sean?
Yeah.
Yeah, Landy, we can hear you. You can continue. Landy? Yeah, we can hear you. You can continue.
Kristen, maybe just put Petronella online quickly, make her live, and just apologize for technical difficulties, and that we'll be back in like 5 minutes or like 3 minutes. I think it will sort itself out now.
Okay, Petronella, you need to put your camera on.
Yeah, I have. Hello, everyone. We apologize for the technical difficulties, but we will be able to put Landy back on in a few minutes. So please just bear with us. She's only rounding up right now, so we just need a few minutes before we're able to close the session. So we're just trying to see what probably went wrong. So yeah, so just give us a few minutes, 2 minutes, and then we try to handle this.
Awesome. I think Landy.
Okay. Yeah, I think maybe we can put Landy on.
Maybe Petronella can do a trick while people wait.
Okay, Landy, you can continue. Okay, guys.
Can you hear me?
Yes, we can. You can continue, Landy.
Oh, I'm not sure what happened there. My apologies. Sorry about that, everyone. I'm not sure what happened there. But to end off, I'm almost done anyways, but I wanted to use an example that will illustrate what I have been talking about. So if you think about buying a car, that's the financial goal. The second question would be, how long do I have? Let's say, for example, you've got 4 years. The third question would be, how much am I willing to put away? Let's say, for example, that's 250 Rand. The fourth question is, how often do I want to put this money away? For example, let's say on a monthly basis. And what's your risk appetite? Number 5, let's say that your risk appetite is moderate, or how much risk you're willing to take on is just medium. You don't want too much risk, but you also don't want too little. Just by answering those 5 questions, you have helped yourself decide which fund would be suitable for you. Why do I say that? Because you've got time. Remember, one of the things that I said is the longer the time you have to invest, the more risk you can afford to take on. So automatically, you wouldn't put away your money in a cash fund or a money market. You wouldn't necessarily put your money away in a bond market, all of the money away in a bond fund, for example, because those are low risk, right? So you're now left with your commodities, your property, and your shares. This, we're talking about funds or portfolios or things that hold these kind of building blocks or assets. Now you're left with three. But you said that you don't like too much risk. You have a moderate appetite for risk, right? So you will definitely not put your money away in 100% shares, a fund that holds shares 100%, and you won't put your money away in a fund that holds 100% of property. What you are going to look for, because of your risk profile, because of the amount of time that you have, and looking at the frequency of your investments, you are probably going to choose a moderate fund, or what we call a balanced fund. You're going to choose a fund that has a mixture of all these things, little bit of shares, so that you get that you've got enough time for the shares, to invest in a fund that has enough shares to make your portfolio grow. The fund that you're going to put in will also have a little bit of cash to cancel out the high risk of the shares. So your fund is literally going to bring all the asset classes together. But if you had more time, and if your risk appetite was exceptionally high, if you had 6 years to buy your car and your risk appetite was high, you would probably go for a fund that will give you 80% equities or 80% shares. So that's how you choose which funds or where you're going to put your money in. I hope that makes sense. I'm going to recap this last part. First part, you answer those 5 questions. From that, you conclude. For me, I'm either looking for a low risk fund because I have a low risk appetite. Then you go to step number 2. What are the low risk asset classes? What should I be looking for in those funds that meet my criteria? If you are moderate risk, what should I be looking for? Which asset classes should I be playing around with or looking for when I want to put my money away? If I've got a medium risk appetite. And if I've got likewise a high risk appetite, which asset classes speak to my need? Speak to my need both from a time perspective. The more time you have, the more risk you can sometimes afford to take on. Which asset classes speak to that, and which funds hold those asset classes? I know it's a lot to comprehend right now, but I hope I've broken it down, that it's not too technical, and gives you something, or it gives you a roadmap on where to start in answering, where do I put my money away, right? Yeah, I think that's probably it from my side. I don't want to go any deeper than what I've done, because this is not a it's not a CFA class or anything like that. So, but I want to leave you with a thought, and I want to congratulate each and every person that is present here today, because you are one step closer, if you're not already, right? Sometimes we think of financial freedom as this grand thing that you're going to get one day in life. If you do not have any debt at the moment and you have no asset, you are free. You've got no one knocking on your door asking for money every day. Yours is to maintain that freedom or to improve your financial standing, as Rudi spoke about yesterday. So I want to leave you with a thought, and that thought has always guided me in the type of business things that I get into. It's guided my investment principles, and the thought is that you may not necessarily have what you need or want today, respectfully so. You may not have what you need or want today, but you are absolutely never without the seed that will produce it. Whether that seed is knowledge, whether that seed is money, whether that seed is the network of people that you surround yourself with. You are never without the seed that will produce what you want or need today. And I think on that thought, I'm going to say thank you, and here's to all our financial freedom journey. Petronella and Sean, thank you so much.
Oh, wow. Thank you so much, Landi. Wow, it's been absolute pleasure having to stomach everything in. Wow, I hope everyone found this very delightful, something to think about, a lot of stuff to think about, a lot of stuff to research on. But thank you so much for this information and giving us so much detail in what to consider when we actually want to do investment. I hope you have enjoyed the session, because I have. I hope you also enjoyed Rudi, because I did. I learned a lot. So I just hope the principles that they've been putting out there, you're able to relate and able to just start practicing them. Knowledge is not enough if you do not practically implement it in your life. So remember, tomorrow we have a Q&A. So we're just going to leave all the questions for tomorrow. So they will be here to answer most of the questions because we've received a lot. So please join us tomorrow, same time at 5, and we will be, they'll be so delighted to just answer your questions and, help you in this financial freedom journey. So yeah, tune in tomorrow. I hope to see all of you. Thank you so much for joining. Remember, if you want to win a prize, you should have sent in your question right now, because we're closing everything at the end of the session. So yeah, see you all tomorrow. Have a lovely evening.
Thank you so much. Cheers all.